Hello and welcome back to Soar Financially, where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the @JR Mining Guy on Twitter and the CEO of the Soar Financial Group. Tremendously appreciate you joining us here in New York. We're at the SME Current Trends in Mining Finance Conference, and I'm joined by Mike McGlone. You're a senior commodity strategist over at Bloomberg. Mike, it's the first time we're meeting in person. I was looking forward to this for a while now. Really appreciate it and great to see you.
It's my honor to prove that you're not a hologram, you're actually a person.
I do exist. I travel way too much, according to my wife. So, no, glad we could make this happen and really appreciate you taking the time. We last spoke February 22nd, plus or minus a couple days.
Yeah.
It was right before a big metals breakout.
Yeah.
And right before PDAC as well, the world's largest mining conference. And usually there's a PDAC curse. That's the treaded thing. The last 13 years, you were spot on. If you would have sold your gold and your mining stocks March 1st or March 2nd, you were spot on. This time is completely different. We've seen a complete 180 in the markets, and we have to analyze it. Yeah. Maybe we'll start there timing-wise. What has changed? Why did the metals start running? Why is gold? Why is silver? Why is copper running?
So I'll start with the end of that part. I think copper and silver are in the same bucket now. Silver's no longer in that bucket with gold anymore. It's much more industrial. And the way I see it is they're catching up to they're catching up, both copper and silver are catching up to gold and beta. So gold's been leading it, and gold is, to me, is the most enduring bull market commodities. And that's not so profound because gold typically beats all commodities over time, particularly on a total return basis. But I see gold still as the best performing commodity this year. It's been backing up, well, not backing up, but it's been getting some catch up from silver and copper. The problem is we know silver's nicknamed the devil's metal for a reason. And when you see what's happened recently with the big spike in copper and silver, now new highs in copper, is I'm more worried about the autocorrelation factors. I mean, you don't want to, it's from a trader standpoint, you just don't want to lay in the copper after it bounces like this. Now, let's look in the key levels I've been looking at. Once it broke above $4 a pound, straight to 5, new highs, $5.20 a pound. But now the key thing I'm worried about is you look at managed money net positions on copper, i.e. hedge funds. They're very long. I mean, they've been on this trade and they have itchy trigger fingers. I mean, they're not the kind of traders who want to drive a long-term enduring bull market. So I think the trigger will be, at some point they'll liquidate, make copper go down, and it's the macro that I'm really worried about, is copper is catching up to beta. And then I look at the stock market. You can overlay copper and the S&P 500. It's almost tick for tick. For almost 10 years, it got a little cheap. It's right back up, and they're 1-to-1 with S&P 500. And to me, the data I look at is the S&P 500 beta in the U.S. is about the most stretched I've seen it since actually 1999 and 2007. So very expensive beta.
I'm trying to figure out where we go now, because we need to talk gold and silver, but I want to stay on the economy to a degree as well. S&P 500 and that correlation, because the question is recession fears. I've looked at the copper chart, and it really fits sentiment as well. So if I look at it, we had a really good beginning of 2023. Copper went up a little, but then it sort of retraced. Nothing really happened for almost 7-8 months, and then it broke out. It really coincided with the news and maybe sentiment change that the recession might not happen, or we'll have a very soft landing. Where do you stand on that, if I were to correlate that?
Correlation is, I just like to say the pendulum swung way too far for the recession. It swung way too far back. That was last year, way too far back the other way. No recession, no landing. And now it's just going to swing back a little bit. It's almost, to me, a guarantee it will. And the key thing I point to is, in my space, in commodities, first of all, we still have an inverted curve, and most of us are impatient, so at some point that will matter. Leading indicators are still negative, but the key thing is I look at it is the Fed is not going to ease until the market makes them ease by going down. It's seriously silly how much the market's priced for easing, yet people are talking things like a Fed put. You don't have a Fed put with markets making all-time new highs, massive speculative rally, and the Fed's inflation above its targets. It just doesn't happen. So I look over at what's going to happen, I think, is more likely we tilt back towards we are going to get that recession. And here's some key indicators for that. I mentioned some of them, but in my space in energy, we have recessionary trajectories in the demand for diesel in the U.S. and the demand for gasoline in the U.S. I'm using 52-week moving average. So these are analyzed measures, and container boards. I mean, there's all the real economy tilting towards recession. So the way I look at it is, at some point, and then here's some things with the stock market. The U.S. stock market as a market capitalization basis is 2 times GDP. The last time we really were around 2 times GDP, it's 55 trillion is the market capitalization, was the 1930s. So give you an example, 2007, before that big correction, it was about 1.2 times GDP. So it's that expensive. So then I look over, so what really drives markets? We have volatility on the S&P 500 at levels below, if you take out the T-bill rate, below where it was right around 2007. That's the lowest since 2007. To me, that was a key indicator because volatility always mean reverts. And then you look at things like simple price. The lesson I've just published recently is you look at the S&P 500 versus its 100-week moving average. It's 22% above its 100-week moving average. That's never a good place and sign. It's very stretched. And so I overlaid that with 2 ratios, gold versus silver. Every time we get the stock market that high, gold versus silver typically bottoms and then goes back up because the stock market mean reverts. And gold versus copper, same thing. So these are somewhat technical, but the fundamentals are serious. If you look at bond yields in China, all-time new lows. CGB yields, 10-year note yield in China, it's 2.3% or so. Our database goes back 18 years. That's 200 basis points less than the U.S. So from a bond yield standpoint, indications of really happened in the market, you see severe deflationary forces. So I think that to me is what I'm worried about is this recent bounce in the more economic sensitive metals, which includes silver now, but copper, and gold's just hanging out. So by the end of the year, we should expect a pickup in U.S. volatility. Who knows what's going to happen with the election? And gold, I think, is going to be the more enduring performer. Now, if we don't get that, it would be different this time. It's very rare for the stock market to just keep marching up higher when it gets this expensive.
Well, bond yields you brought up as well. And we're going to get to gold and silver. Like, what
it's
led to it? I think it is connected, but I just isolate the topics a little bit. Bond yields have been dropping. Like we were, the 10-year was almost touching 5% again, and now we're trading about 4.5%. What is driving that? It seems like there's
the rest of the world. So U.S. is, first of all, it's a problem with the dollar. I like to compare, if you take bond yields in the top 5 countries in the world, starting with, obviously, 10-year note yields, U.S., China, Japan, Germany, and India, that average is about 200 basis points less than U.S. Fed funds rate. So the Fed funds rate is really high, and all these bond yields are lower. So what bond yields are telling us is there's deflationary, recessionary forces in the market. They are pointing that out. And I'm from a bond. I came from the trading pitch in Chicago. That's an indication that, particularly in China, that all you hear about is this recovery. It's bogus, I think. It's a typical bounce in a bear market and a big recession. And then we have to tilt over to the macro. So first of all, I think U.S. inflation and bond yields are going to collapse. And part of the reason inflation's sticky is because the stock market's going up. Remember, it's 2 times GDP. It's irrational to think it doesn't matter that much. The stock market goes up, sticky inflation. Stock market goes down, inflation goes down. That's just the way it is now. 2 times GDP. It hasn't happened in our lifetimes. Just for a little while before the Fed started hiking in 2022. So to me, that's the key thing is bond yields are telling us something. They could be wrong. But my indication from a macro standpoint is that's the tilt towards a global recessionary, deflationary trend. The thing is, it's not profound at all. You look at the macro, the big picture of cycles in history. Anytime you have a big pump like we did in liquidity and liquid assets on the back of COVID, you always get the dump. And I think it's just getting started.
Okay. Let's talk gold and silver. I want to sort of put a bow around the conversation at the end and talk where copper is going as well, because you mentioned China might go bust or might have economic issue. Not bust is a strong word. Sorry. Let me rephrase that.
I'll explain that.
But let's talk gold first, and let's talk silver. Gold also, like, sort of pre-indicated what is happening, and it was a precursor to the copper rally as well. Perfect storm, or was there one single trigger that really pushed gold to this level?
I like the latter. I like to say, first of all, the deepest pockets on the planet are buying gold. Now, everybody knows this at the conference here, and that's the World Gold Council points out. The word they use for central banks buying gold, led by China, is colossal. Now, this is on the back of the unlimited friendship between President Xi and President Putin. To me, that shifted the world order. Its 2 major customers, China is an export economy, are GMTFO. Acronym I learned in the trading pit, get me the heck out, of China. You can see it every day in the U.S. You see it in the election. There's competition between the 2 candidates. Who can bash China the most? It gets votes. That's bad for China. Then there's a property crisis. What I think is happening in China is very similar to what Japan did in the peak in 1990. GDP in China right now, $4 trillion, is the same as it was 30 years ago. That's going to happen in China. It's going down that way. What stops that? So I look at this unlimited friendship started this tweak of buying gold as a backup some way to get out of the dollar. It's the only alternative. And there's a little Bitcoin in that space. The key thing that's significant for me, Kai, is during this period, since the peak in 2020, there's been about 100 million ounces total buying of gold, a little bit more from central banks. At the same time, ETF outflows have been about 30 million ounces. I mean, it's the most significant amount of ETF outflows in gold, from 110 million ounces to about 80 now, ever. And ETFs have been around for 10 years, with the gold price still going up. So here's what's going to happen, and no risk in making predictions. At some point, there's going to be a tilt towards buying gold from normal investors in the U.S. Right now, I'd like to say is why buy gold if you're a U.S. investor, most Western, when you can get this, the stock market's on a tear and you get 5% T-bills. Once that reverts, which will happen, it's a question of time, all that money starts flowing towards the rock. The key thing I like to end with is the rock stocks. I mean, the rock gold is beating stocks this year. So gold's up 17, 18% total return versus the S&P 500 total return around 12%. That's not a good sign for this AI-driven stock market. So I'm sticking with gold. I think and you look at the gold stock market ratio, it's really low. You look at the stock market GDP ratio, it's really high. Just a little normal reversion takes a spark. I don't know what the spark's going to be, but that's what I think is happening.
$2,400 gold.
Yeah.
On paper, it looks expensive. Let's talk sentiment, because you talked about the retail investor coming in buying gold. We've seen quite a bit of inflows into the ETFs, which I'm assuming is partially retail driven as well. But perception of price, I'm curious. Like, is $2,400 expensive? Do you see some profit taking maybe as well?
Always.
Because like we talked off camera earlier, is like the World Gold Council every month puts out a report, and Europe is massively selling gold while the US and Asia are buying on the ETF side. Like, is that profit taking? Like, is $2,400 too expensive for the retail investor?
I think some of that is. I look at the total holdings, and recently there's been inflows. Maybe those gold outflows, which has been an enduring trajectory now for almost 4 years, are starting to flip up. That's the signal I'm waiting for. So the way I look at it as an ex-trader, you see I used to have hair, is I try, it's on my DI list, Kai, is try to ignore the stuff that used to trip me up. As an ex-trader, I know what used to trip me up. I know what stopped me out, is look on the macro big picture. That's like, say, okay, it easily could drop back to 2,200. But to me, the trajectory in gold is almost unstoppable. And think of it in non-dollars. I mean, the dollar is the strongest currency, and you get 5% in your T-bills. When gold goes up in that environment, there's a reason. So yes, there's risks that central banks will stop buying. To me, that's going to take a significant, one phone call would do it, but it's not going to happen. That's one phone call from President Xi to President Putin. Hey, Vlad, dude, this unlimited friendship, it's not working out. So we just saw the latest hug of unlimited friendship. They're doubling down. Let them do that, right? And the rest of the world's moving on. Gold's in the middle. So to me, that's part of that global recessionary trajectory when China is exporting massive deflation. I mean, just getting started. Why do we have all these restrictions on their automobiles and solar and things? Because they shifted a lot of their bank assets away from property to exporting stuff. And then they pissed off their best customers. Like, good luck with that one. It's just a classic case. So the way I look at it is I stick with, over time, you can see gold almost always beats other commodities. And now, to me, it's almost a perfect storm for to do that. And the key next inflection point I'm looking for is those ETFs to start shifting back higher. But I don't think it really matters, Kai, until we get a little bit of volatility pickup in the U.S. stock market, a little bit of a normal back and fill in a bull market. At some point in our lifetimes, we haven't had a decent bear market in the U.S. stock market since that bottom 2009. We've had corrections. And the difference this time is interest rates have gone up on the elevator, and I think they're going to go down on the escalator. And here's one key thing I think gold is figuring out, is when people say there's a Fed put, it's such an oxymoron, because the Fed will never support the stock market at record highs with inflation above its target. If they do, it's silly. History will judge them not so well. You only have a Fed put and stocks go down, inflation starts going down. Typically, stocks need to go down. What does that mean? That's what's going to be the next trigger. So I just look at it as, it's not simple, but it's complicated, but it's just that pendulum of sentiment swinging back a little bit towards the recession that's going to happen, particularly if rates this high. And the key thing is there's so much wealth creation and wealth indicating from the high stock market. That's the number one thing that matters everywhere. Like I said, the valuation versus GDP, people say I'm focused on it too much, and that's when I get pushback, and I hope to get that pushback, because when everybody agrees with you, you're usually wrong.
Yeah. And you don't want that. You don't want that. often says like when gold rallies and gold really breaks out, you don't want to see that if you're the U.S. Like one of the arguments was like, well, the U.S. is sort of suppressing the price of gold because they might run into problems with a higher price of gold. Now we're sitting at $2,400. Let's flip the book. Let's flip the page here. Let's look at from the other side. Like, what does that mean in the other way around? Like, what does that mean for the U.S.?
So
does it indicate something is really breaking? Because we always talked about reasons for a higher gold price, but let's talk about gold at 2,400. What does that cost? What's the ripple effect there?
So it's as Warren Buffett called it, the rock. When the rock beats stocks, beware. So first of all, we're at a metals and mining conference. I love going to all the different conferences. I go to agriculture, and I go to energy, and I go to cryptos, and there's a different sentiment. And it's always been the case that, oh, the U.S. is suppressing the price of gold. I'm like, that's kind of silly. Show me the evidence, because to do that, you need to have money into flows, into futures, and there's got to be a record of it. It's just kind of silly. In the short term, maybe. But what I think is happening in the macro big picture is it's the lesson I learned coming to New York in 1993 from the Chicago trading pits was the stock market's designed to go up. It is until it gets too expensive. There's not much you can do about it. And it's the most expensive in my lifetime. And there's a lot of signs it just needs a little bit of normal correction. The difference this time is the lessons of history. It's like Jeff Booth says in his book, The Price of Tomorrow, is humans are about error correction. The error we learned in the last 4 years was too much liquidity and inflation. Now, yes, 4 years ago, there was a risk we could all die. We didn't, but we created that liquidity, we created inflation. That's the biggest problem for your average person, is that inflation, because their wages haven't gone up, and some people don't own homes like the rest of, some of the Western elite. So to me is what's going to happen in the big picture is we're going to start getting a normal reversion towards a recession, and the Fed will not be able to ease with the ease they have in the past because of the lessons of easing and too much inflation and too much liquidity.
Okay, so we're not at that breaking point yet. I think Rick Rule says, like, I own gold because I don't want it to see go to $5,000.
Right? You own it. It's a hedge, insurance.
Yeah, right. Because if it hits $5,000, something is amiss on the other end, right? Yeah. So I think that was his thinking. Like, who knows? Maybe the U.S. is complete shambles, or the economies worldwide are in shambles.
Well, right? That's why I like to say, if the U.S. is shambles, imagine the rest of the world. So right now, it's the complete shining star, particularly after the unlimited friendship. People realize, okay, there's major problems in China. Just know all the history, lessons of history. The latest book I read was The Price of Time. Chancellor, I think was the name. Boom and Bust. Quinn was on the authors. Victor Shivitz, in his book, The Great Rupture, pointed out China always has cycles and reverts. And what they doing now is just a perfect storm for a normal reversion of a rapidly expanding emerging market. So to me, that's the main driver. Major gold bias there. If you're a Chinese citizen, there's not much else you can buy. Stock markets are really cheap, but bond yields collapsing. Property market is just like the peak. And the statistics I got is the property value of China from the book The Price of Time. At its peak was about 4 times GDP. That's about what Japan was at the peak. Stock market at its peak was about 2 times GDP. That's about what Japan was at the peak. I worked for Japanese firms. I remember feeling that. And then you revert. The difference is what President Xi did, I think, will go down in history of one of the dumbest things ever. The Economist, the editor of The Economist, on a Bloomberg interview, I forget her name, the quote was, economic incompetent. So we'll see how this works out. Yeah. But this, to me, is where gold's in the middle. It's the bias. And at some point when the U.S. investors realize that, okay, we've had the best run in our lifetimes, the boomers just had a great oomph for their retirement, and you can get 5% on a T-bill, and you still get 4.50 on a 10-year note, to me, that's what's going to happen. And I love when people push back and say there's going to be inflation. I'm like, I think it's more severe deflation, because that's almost always what happens after you get a cycle that pushes the base for inflation measures up, and then you kind of just trickle down a little bit.
Let's talk gold, silver. Gold, little brother, silver, of course. We finally broke through $30. Quickly went to 32, 32.50. Fairly fast move. What are the reasons behind it? Just a catch-up rally? Because that $30 was a big holding block, or what do you call it, a big wall, right, for it to break through. What is pushing silver higher?
Catch-up rally.
Just catch up.
I think so. Well, gold's driving everything. I mean, silver, to get it to an all-time high, it's got to go 50. I remember that in 2011. I was at S&P running commodities there. And a lot of us remember it. And it's known as the devil's metal for a reason. So if you overlay silver and copper, It's the correlation's increasing daily. Silver is more like copper now, and it makes sense. It's an industrial metal. Central banks are not buying silver. But the key thing that might be happening, I'm getting whiffs of this, don't know for sure, is if China is hoarding gold, which we know they are, and a lot of central banks are, why not silver and copper in that space? You don't hoard crude oil. Now they've rebuilt their SPR, their Strategic Petroleum Reserve, but the metals you can hold. And so one thing I love about the metals in the commodity space is S&P indices, Bloomberg indices, 2018 created the all metals index. And part of the reason is because I asked them to, because in commodities, over time, metals beat everything. Low elasticity of supply, increasing demand and adoption, and the coal decarbonization, electrification, digitalization trends always good for most. And then you got gold together. All the other commodities have that high price cure. And they're still under the headwind of that, like crude oil and everything. But silver, I think the technicals were great. Once it got above 26, it signaled a breakout, and it gave you a dip back down to 26 and went up. I'm glad I don't trade it anymore, because if I did, I'd be messed up. If I just watch it and don't have a position on it, it works right. So now I think the next, it backs up. 30 is now support. Where it goes next, getting above 50 takes a while, but I think it's going to depend on gold. And the key risk I pointed out earlier is silver and copper have a much higher beta now to the stock market, U.S. stock market. And by some measures, the U.S. stock market, in my view, is most expensive in 20 years. So here's something I published recently. Take the U.S. stock market, S&P 500, divide by GDP. Just add 2 zeros, and that ratio over time is about 1. I go back to 1928. Right now it's about 2. Okay, and the average is about 1. Same thing, I'll just take the S&P 500 divide by gold. The ratio over time is about 1. Now it depends if you go back pre-1971, before we went up the gold standard, but that is about 2.2. So versus, I mentioned this earlier, GDP, the stock market's very expensive, and versus gold, it's very expensive. But if you put those two together, it's the most expensive in our database in 100 years. Just needs a spark for reverse.
Let's talk valuations. I think that's a good point, because you also, this morning in your piece, you compared gold and copper, and you're saying gold is still undervalued in comparison. The question now is, based on what you've been saying, is gold undervalued because copper is too high and copper will drop? Because if you expect that recession, copper should drop. That would be my assumption. Economic worries, who needs copper if the economy is in turmoil, right? Is that what you're sort of meaning by that?
That's it. Also, and one thing I like to point out is enduring trends with reason to continue. Gold beating copper is an enduring trend, particularly since the financial crisis. It's been going up, as Dennis Gartman say, from the lower left to upper right. And I look at that and so what's going to stop that versus what can accelerate? One of the key things I pointed out is the stock market's very expensive, needs to avert. Volatility in the stock market is very low, needs to avert. Bond yields in China are collapsing. So these are kind of my leading indicators that it's going to continue to do that, break out higher. And you're getting a little dip in that gold to copper ratio. So I look at the astute traders and investors are probably buying the dip. I should be, I think. I have to put a view on it. And it's a question of what reverses. So I look at it as just a matter of time that enduring trend continues higher. Here's one example. In a similar way, one of the most enduring trends in commodities is the excess of supply in crude oil and liquid fuels out of out of US and Canada versus demand. That's shifted the whole space for crude oil and petroleum prices to go lower. That's accelerating. And during COVID, people thought that was going to end. I'm like, what's going to make that end? It's an enduring trend. You need something significant. And the key thing that also always drives that part of the space is prices. Prices spiked, create more supply. It happens in grains. And in metals, it's not really that case. But what I'm worried about right now is this clearly speculative bounce in copper is going to be less enduring than in the bull market in gold.
Just to wrap it up, are we going to see another Fed rate hike before we see a cut?
I don't think so, but just imagine what would happen on a global basis as the Fed hikes. The ECB has said they're going to cut in June. UK is going to cut. A lot of European countries are going to. China is throwing tons of liquidity at the system, not only in fiscal and monetary, cutting a lot. Brazil's already starting cutting. So the world's tilting towards cutting. If the U.S. hikes, what does that do for the dollar? The global economy will not collapse, but have some major problem. All the other countries have to support themselves. What's happening in the yen lately? It's not about the yen's weakening. Why? Well, there's 0 interest rates there and 5% in the U.S. So the yen will weaken over time, and they've had to support the currency. The biggest problem with that is the dollar is a wrecking ball already. And the problem I see is the Fed is not going to cut. You said a hike. No, that's a shocker. But it's not going to cut until the stock market goes down and tells them to. And it's the most expensive in many measures ever. So to me, that's where it is. If they were to hike, that just accelerates. It's a great opportunity for more tactically orientated people, but for overall investors on a global basis, it's basically what I think really hurt the U.S. and the global economy. Because we're at the stage now, remember, we had 100-year events. And it's distorting those people who like me are typically don't have a lot of patience. It'll happen. Leading indicators matter. The inverted curve will matter, and the Fed hikes will just make that whole process of that pendulum swinging back down towards that recession. That's not going to happen. It's completely out of it. You look at it as a trader, and it'll head towards that recession, which is a matter of time. I think, like I said, all the indicators I have in energy demand, leading indicators. There's all the things we can talk about, credit cards and all that stuff. That's all tilting towards the things that used to matter, and they're not going to matter until the stock market goes down and tells the people to shift their attention.
Very last question, Mike. Citibank put out a report, gold to $3,000 over the next 6 to 18 months. Would you agree with that price target?
Matter of time.
Matter of time.
I don't put time. Well, did you say 6 to 18?
6 to 18 months.
Yeah, that's good widespread.
Yeah.
I mean, at least they have some COIA in that, up to 18 months. And what's going to mess it up? I've just been saying I have to admit, Kai, a lot when I get wrong, it's most important in a minute. I've been saying it too long. I think starting in 2019. To me, it's a matter of time it gets to 3,000, but I'm not going to put a time on it.
Perfect. Mike, amazing meeting you here in person. Absolutely appreciate the conversation. Thanks so much for taking the time. And where can we follow your work? Let's do that first.
So on Bloomberg Terminal, but LinkedIn, Mike McGlone, Senior Commodity Strategist, and on X, Mike McGlone at 11. So thanks for asking, and I'm looking forward to coming back and see how things work out. And if you're wrong, if I'm wrong, Mike, you're an idiot. What does that mean? That's fine, but I'm a strategist. I mean, I used to run money. Now I have the benefit of just saying it. I have to complete respect for all the people who do it, and I hope I don't. I hope I help.
Well, the thing is, like my number one thing is you can make a prediction, but you got to stick to it.
Oh, yeah.
You can't just flip flop, and you got to have the data to back it up. Doesn't matter what your end result is, like what your prediction is, as long as you have the data that you use to back it up. And you definitely have that.
Oh yeah, well, I'm completely losing. I did it in 2007, but the indicators I see for the stock market are worse than what I saw back then. And of course, I was a year early. It was one of my best trading years in 2008 ever. I was a trader back then. But I didn't have a good year in 2007 because I was shorting everything, and it just took a while.
Yeah, well, we've all seen The Big Short, and Michael Burry was suffering for, 18 months to get to that point?
Most of the way it usually works is you get stopped out, and then it goes down. And that's a key lesson about investing most of our viewers and listeners will see that. Like, yeah, it's easy to say, but actually putting a profitable position on and being right, it's not always the same thing. You can be right and still lose. You can be wrong and still win, but it depends.
Yeah. What is it? The market can stay
irrational longer than I can see.
Absolutely. Fantastic. Mike, thank you so much. Everybody else, thank you so much for joining us here on Soar Financially, here in New York at the SME Current Trends in Mind Finance. Really appreciate you tuning in. Hope you all enjoyed this conversation. Hope we asked the right questions. If we did, and if we didn't, put the right questions down below. If we did, give us a thumbs up. We really appreciate it. Subscribe to the channel. We'll be back with lots more here from New York. And thanks so much for tuning in.